Hey everybody, Economic Ninja here. I hope you're doing well. I think this is a really good story. I want to get it out as soon as I can because we've been talking about the dollar-euro trade for a little bit. I've just been briefly going over it because it's not really a stock channel. I do cover stocks. I own stocks. But the dollar-euro story is very important because of how tied, in my personal opinion, not financial advice, how tied the Federal Reserve and the Bank of England are, okay? Not only that, besides the currencies being tied, the banks being tied, but also the truth about our trading partnerships, okay? So we've seen over the last decade, a little bit more than a decade actually, some interesting sleight of hand tricks, let's say, for lack of better terms, when the two banks want to hide things, let's say between quantitative easing and other things, they can easily go between the two banks. Now, without diving into all of that, I'm going to talk about, I just put out a video on the rate hike for the ECB, and that a handful of their governors have voted to go well above the what was just recently the quarter 25 basis points, which is a quarter of 1% rate hike, and they're voting now. Let's go either half a point or half a percentage, 50 basis points, or even 75 basis points, which is massive. And I believe, in my personal opinion, again, not trading advice, this is going to cause catastrophic effects to the real economy, okay? Which will not be felt for months down the road. You'll start to see it come out in, cost price index numbers, all kinds of things, right? But Main Street cannot service their debt at higher rates, okay? Especially with all of the debt that's been accumulated, okay? But right now, the euro is slipping to the dollar. So let's dive right into the story. Again, I'm going to link it in the description below. It's entitled, The ECB Prepares for March Policy Recalibration. Q4 rate hike, as DB says, ECB pivot is here. Buy the euro to USD. Now, I do think that could be, again, not professional advice, could be a play here because the ECB knows they need to bring value to the euro, especially when it's up against the US dollar and it's been slipping, and that could be a heck of a trade, right, in the Forex markets. But remember, guys, I want to explain something right now. If they really cared about it, they would raise some, they would go big right now. They're saying, okay, we raised a little bit. We're going to stop quantitative easing, and we're going to go big in March. And March is going to be, I think we're setting up to be fireworks in the world's economy, because you not only have what they are bluffing right now to be a massive rate hike in March, you also have the Federal Reserve bluffing to make it even larger than a quarter of a percentage, 25 basis points, larger than that, which I just don't personally believe they can pull off without really detonating the economy. So here we go. So with markets still in shock over Christine Lagarde's hawkish pressure and Italian bonds at yields that scream a new financial crisis is just around the corner, the trial balloons have started dropping, with Bloomberg reporting moments ago that the ECB policymakers can imagine recalibrating their outlined policy path in March. It says, according to the report, the Governing Council agreed at Thursday's meeting that it's sensible not to exclude a rate hike this year, and that an end of bond buying under the APP in the third quarter is possible. This means that the ECB is now open to a rate hike in quarter four. Now, guys, I want to explain something again. They have announced that they are going to stop their quantitative easing program. Okay, so again, this is all rhetoric until they actually do it, right? But this is the first step that any central bank has in their toolbox when things are going bad. And what is that? It's threats. It's, we're gonna do something. It's like, well, hey guys, why don't you just do something? We're gonna do something. Why? Because that is the first and logical step in any Fed governor's pocket, because they don't have to do something and they want to see how the market reacts. Okay. Now, if recent history is any clear indicator of where they should be going with interest rates, right? This last month was the worst in the S&P 500's history, dating all the way back to January of 2009. And if you weren't investing, if you're too young to remember that, you weren't like solidly investing. And I'm not talking about your pension fund, your 401k. I'm talking about you actually owned, blue chip stocks, NASDAQ stocks, S&P stocks, things like that. You were actively investing in stocks in 2009, January. It was an absolute bloodbath because it was still 4 months. Clearly, right in the rearview mirror, you were seeing the collapse of Lehman Brothers. and the Great Recession starting, okay? And the market had not bottomed in January. It didn't bottom until, I believe, March or April of 2009. There was still a lot of blood in the streets. So right now, the Fed and the ECB are being hawkish, but actually just in theory. They're just threatening. We're going to do something. Like, do it. Well, we're going to do it. Or crap. They can't do anything, all right? And if they do, just looking back in January, it shows that the market believes there is no way in hello that you guys can pull this off. And if you do it, it's like you're trying to do something on purpose. All right, guys? So I think this is very interesting. This trade, the Euro USD trade, could actually be one heck of a trade because they're really coming out. I mean, they said, hey, we're doing this. Now, like a few hours later, now we're going to do this. It's pretty darn impressive. So, guys, I wanted to bring you this story. Thank you for watching. Thanks for all the people hitting the thumbs up button and sharing these videos. The Economic Ninja is out.